Good evening. I'd like to call to order the July 22nd Finance Committee regular meeting. Claudia, would you call roll, please?
Chairperson Reinhardt,
Here.
Vice Chair Gonzalez,
Here.
Member Gardner,
Here.
Member Darnell,
Here.
Member Brown.
Here.
Thank you. All right, let's get started. Jay, current business.
Chairman, committee members, Jay Glover from PFM Financial Advisors. We are the city's financial advisor, so when there's a need to access the capital markets to issue debt, whether that's for new money issuances or refunding, we step in and help the city with that process. And we're here today to talk about a refunding opportunity whereby the city can take some of its existing debt and refinance that at lower interest rates to save money. So I think you probably have a copy of a memo we prepared in front of you. And I'm just going to briefly walk through this. It'll probably only take a couple of minutes, and then we can address any questions you all might have.
Hold it, Jay.
Okay.
Let us.
It's just a one-pager.
Labeled PFM should be on your left side. The standalone copy.
Anybody find it?
No.
Easter egg, huh?
Let's say no on it. Unless you can see it in here that we're just all overlooking it. I got a copy of it.
It was with this.
We have investment formats.
I got a couple
Is
extra.
it in that?
I've already read it. I've already read it, so.
No.
Here's some extra copies. I mean,
Yeah, we have, nobody has any.
I already read it too.
Give it to them. I'll just, we can.
I think this rounded up in a. Yeah, we can share one.
Yeah, I'll just look off you guys. Thank you.
All right. Don't get too close. I didn't take a shot.
All right, Jay, now we can
great.
talk
yeah.
business.
And I'll walk through this slowly, and if you have any questions while I'm walking through it, please feel free to interrupt me. But back in 2010, the city had a need to fund some capital projects, mainly road improvements through the issuance of debt. And at that point in time, we were in the midst of the American Recovery and Reinvestment Act, which was part of the stimulus package. And there was a product as a part of that called Build America bonds, which really allowed issuers to issue debt at lower interest rates than traditional tax-exempt financing. So what the city did back then was they actually issued a taxable financing in 2010, and they actually get a rebate from the federal government related to 35% of the taxable interest that's paid, which at that point in time would have been lower than issuing traditional tax-exempt debt. So back then we did that special product. It was only available for a temporary period of time, really as part of the Stimulus Act. That bond had 10-year call protection on it and is actually able to be called on September 1 of 2020. So it had a 10-year lockout where the bonds could not be called or paid off, and we're approaching that date. And at this point in time, there's a little over $34 million of principal amount that remains outstanding. The interest rates, again, which are taxable, range from 5.01% to 5.99%. Those are the existing taxable interest rates. Given the low interest rate environment we're in, I'm sure you all follow the markets, interest rates started to rise late last year with the anticipation that the Federal Reserve was going to continue to increase interest rates. Really early this year, due to a number of things, they reversed course and said, we're actually going to cut interest rates up to 3 times this year. The first one probably being in July, if most of the economists are right. right. So really, we've reverted back to all-time historically low interest rates, which really provides a great opportunity for all issuers to look at their existing debt portfolio and refund debt at lower rates to really lower the debt service cost. So that's what we're here today to talk about, an opportunity related to those 2010 bonds where we can actually now go in and issue traditional tax-exempt bonds to pay off the taxable bonds and lower your annual debt service each year. Again, the bonds are callable September 1 of 2020. So what we're proposing today is that the city move forward with what we call an advance refunding. So you would issue the bonds as soon as we can get the documentation together, and you would put those proceeds into an escrow to pay the bonds off at their call date, which is about a year from now. And the new bonds would be at tax-exempt interest rates. We're estimating that by doing this, the city could save about $2 million on a net present value basis in terms of total debt service, comparing the debt service on the current bonds to the debt service on the new bonds. And that's net of all the cost of doing the financing. There's no extension of the maturity. It's just like refinancing your mortgage from a high interest rate to a low interest rate with the same term and just lowering your annual payments each year. So that $2 million on a net present value basis equates to about $135,000 a year of annual debt service savings. And again, that would be over the existing term of the bonds, which goes out until 2040. So we would lower the debt service about $135,000 a year from today through 2040. So there'd be ongoing annual debt service savings, which would be locked in and not at risk of any market movement in the future. One thing we always look at when suggesting an advance refunding, which you'll see in the additional considerations tab or heading of the memo, is what would happen if we waited until September of 2020 or 90 days before that date, when this could be what we call a current refunding, because then there is not the escrow, which has some cost to it, and you would actually just be able to pay the bonds off essentially when the new bonds close. If we did that and rates did not change, so interest rates stayed the same today, from today until June of next year, you would actually increase your savings to about $2.75 million on a net present value debt service basis, which would be great. But that also leaves you exposure to rising interest rates between now and next June. So if rates do rise between now and next June, and we calculate that to be 26 basis points or more, you would be essentially at a break even. So if rates rise from now till June 26 basis points, you would actually still save $2 million. If rates rose more than 26 basis points, your savings would be less than $2 million, and you would have been better off doing this advance refunding technique and locking your rates in today. If rates stayed the same or went down, obviously you're better off waiting. Given that I don't have a crystal ball and most economists are generally wrong when they project interest rates, we generally look to set a target whereby we would be comfortable moving forward with a refunding. And most local governments say if you can save more than 5% of the refunded bonds par amount, you generally move forward with the refunding and lock the savings in today. And in this case, we're projecting about 6% of the refunded bonds par amount. So when you compare the $2 million of net present value debt service savings to the existing par amount of the bonds outstanding, the $34 million, that's about 6%. And we would generally move forward when refundings are anywhere higher than 5%. And I will mention the numbers that we've run for this analysis are fairly conservative. I think if we were actually locking in these today, you would probably saving maybe $500,000 more than what I'm projecting. So we like to be conservative because even if we got the direction today to move forward, we're still 60 to 90 days from when we can actually do this financing. So we try to be conservative at this point in time. Just in terms of one additional consideration when you look at this, as I mentioned before, this type of product results in a taxable interest rate whereby you get a rebate from the federal government, which was supposed to be 35% of the taxable interest rate. But then this little thing called sequestration came about where the government was looking for additional revenues. So they've actually lowered the amount of subsidy that the city's getting back. So you don't actually get 35% back. You get some amount less than that back. So one of the things, and if it's my understanding is correct, the city has not even received its last subsidy payment from its debt service because when the government shuts down or when things are going haywire in D.C., they're actually not even processing these rebate payments. So they can be delayed sometimes. And most issuers have found just dealing with this sequestration, these interest rate subsidies has been a real headache. So one of the side benefits of actually doing this refunding is not only can you lower your debt service about $135,000 a year or more, you actually eliminate the need for that subsidy. You don't have to deal with the federal government anymore. You would just have a traditional tax-exempt financing outstanding, and you would just pay that tax-exempt interest to your investor. So there's no rebate process, and there's no risk that the federal government might come one day and say, well, we're just not going to do these rebates anymore because we want to keep all this revenue, or sequestration might increase the amount of the rebate. So that's really a side benefit to getting this done. Is not only can you lower your debt service payment, but you also take that rebate risk off the table. So we've seen a lot of issuers have taken advantage of this low interest rate environment to go ahead and lock in these savings and take that risk off the table. So again, I think the plan that we're looking for is some type of direction from you all that this is something you all would like to pursue. The current plan, I think, is to come back before City Council for their workshop next Monday and give a similar presentation, and then get some direction, hopefully to start preparing the financing documents and bring it back to City Council at a subsequent meeting for final approval. So, and I will also mention, if between now and when we actually do the deal, interest rates rise and for some reason the transaction falls out of the money, there's no cost to the city for actually putting the financing together. All of the financing professionals, including myself, legal counsel, and all the other professionals that are involved, work on a contingent basis, and we don't get paid till the financing closes, and we get paid from proceeds of the loan. Again, all of that is built into your savings figure, so net of all the cost of the financing. So there's really no downside to getting the documents prepared. Quite frankly, if we got the documents prepared and we thought rates were going to continue to fall more, we could delay the pricing until a later date to lock rates in. Or if we thought something was happening in the economy with China or just the domestic economy, we thought rates were going to go up, we could then accelerate the pricing. So we're just looking for direction to actually prepare the documents and bring them back to City Council for subsequent approval, just so we'll be in a position to take advantage of the market at the most opportune time. And with that, I'm happy to address any questions you all might have.
I'm sure you would have covered this already if it was the case, but there is no prepayment penalty right now for the bond call.
Correct. Yeah, the bonds are callable September 1 of 2020 at par, so you just pay no premium to get out of these bonds.
But you talked about possibly doing it within the next 60 or 90 days.
Yeah, so that's where the concept of the advance refunding
Okay.
comes in. You would actually put the funds into the escrow. Say if you closed in December of 2019, all of the proceeds would be deposited into an escrow and invested in high-quality U.S. Treasury securities that would then mature in September 1 of 2020 and pay the bonds off at that point. So when that escrow is that irrevocable escrow is funded, these bonds are what we call legally defeased. So they're now secured by that escrow, and then the non-ad valorem revenues of the city that are used to make debt service are now securing your new refunding bonds.
What is the term on the new bonds that they're looking at?
Yeah, so the term would match the existing term. So when these bonds were done in 2010, they were 30-year bonds that had a final maturity of 2040. So the refunding bond is going to exactly match that. So for instance, let me just pull one more piece of paper out. I can give you a better illustration. So right now, the annual debt service on the bonds that are outstanding is about, let me see. Wrong page. So the annual debt service, net of the interest rate subsidy, is about $2.5 million. So you're paying about $2.5 million a year through 2040. After this refunding, we're estimating that you'll be paying about $2.65 million through that same 2040. So your debt service is just reduced by about $135,000 a year with no extension of the maturity.
What's the latest the contract has to be signed?
So there's really no contract that gets signed. What would come back before the city council is a bond resolution that would approve this financing and delegate to the city manager and other officials to actually close the financing if certain parameters are met. And the biggest one of those parameters is, do you meet your estimated net present value debt service savings? And at that point, you know, there's a bunch of closing certificates that get signed on the day of closing, but there's no real, you know, contract per se like you might have in a traditional, you know, type of transaction. So there's really one bond resolution that would get approved that has parameters within it, and if we meet those parameters, we can move forward. And on that closing, the mayor and the city manager and a number of other professionals would actually be signing the closing papers.
Jay, can I also interject a little bit? My understanding was that if we were to move forward, you have an individual who prepares the resolution number for us and everything that attaches to the resolution, so it's well prepared for the bond refinancing, just so you all know. It wouldn't be something we handle.
Yeah, and that's a good point. There are a number of external professionals that work alongside your city staff to prepare this financing. So there is a legal counsel, we call them bond counsel and disclosure counsel. So they specialize in tax-exempt financing, so they prepare the resolution that comes back before city council for approval, and they also provide an opinion that the bonds would be tax-exempt, which the investors are going to require. That same firm, in your case, would serve as disclosure counsel, and what they do is they prepare what we call an official statement. That's like a prospectus in some type of traditional investment. It just explains the transaction to the market and invites people to actually buy these bonds. So you would have that legal group involved. Us as your financial advisor would help structure and price the transaction and try to get you the lowest true interest cost possible, which would thus increase the debt service savings. So those two professionals really work with city staff as well as the city attorney to put what is a number of documents together that actually approve and close the transaction. And as part of that resolution that gets approved by city council, you would also authorize, you know, paying the fees of those associated professionals from the proceeds of the bonds. Again, all the savings are net of those costs.
You said the Fed is gonna, it's lowering rates over the year. So, what's the rush to do this?
Really good question. So the latest thought is the Fed will be probably lowering rates 2 to 3 times between now and the end of the year. The issue is the market knows that. So they've actually priced those rate cuts into place. So the interest rates have already been lowered with the expectation of interest rates going lower. So the market doesn't necessarily wait to adjust interest rates to when the Fed actually cuts rates. They lower interest rates based on what expectations are. So assuming those 2 to 3 rate increases take place, you probably won't see a major effect on interest rates. What could change rates is if something changes and they say, now we're going to lower rates 4 times, or if something changes and they say, well, we're only going to cut rates 1 time now. So it's a very good question, and that's one of the reasons that we're recommending that we move expeditiously to actually get approval from City Council to do the financing, so we can then be in a position to price when we think the most opportune time is. Because if you wait until you think rates are at their all-time low to actually get started, it's a 60 or 90-day process to get the financing documents together. So we want to kind of do that now, so we're in a position to price really any time from, say, I would say November into early next year. So there's nothing that requires us to move right into the market once it's approved. It just gives us flexibility to do so as we see fit.
Wendy,
Yes, sir.
what's your opinion?
So my opinion is at this current state, we were projected to receive from the feds about 600K, which we have not. Thankfully, we haven't counted on that money, which would have been a really huge impact if we would have. We're trying to get out of the subsidiary business right now, and in alignment with our investment strategy, we are seeing the market slow down and is absorbing, and our strategy on investment is changing because of that as well. We want to go a little bit longer term, hold it a little longer because rates are starting to show the change that Jay is saying. So our recommendation, it is the best option for us. We're really not losing anything in this other than, going with the market ahead of the curve, and being more financially sound with it and in alignment with our strategies here at the city.
Do you see any cons?
No, sir, I don't. I really don't. 135K a year is something worth doing. I think at this time and moment where we're trying to save every dollar, we reduce debt. I see a lot more pros than cons. I didn't have any identified that would be of concern. If not, I'd note them for you.
And you're saying you don't want to throw this more cash at debt because have a different investing strategy, or?
No, we're just saying that, based on what we have out there in investing, we have seen the rates starting to slow again. So I can verify, I guess you could say, what Jay is saying, because we can actively see it now as we are rebrokering bonds and it's a strategy that fits right now, I think, just because we're ahead of it. Like I said, we don't have any impact where we're in trouble. By absolutely no, it's a means to failure. We're preparing before instead of after answering the call. We're doing it way ahead of time with enough time and enough time for you all to think of it, aligning to our strategy. So I think it's a sound move.
Any other questions from the board? I would assume, I don't see it on here, but you would like some type of recommendation from us?
Yes, sir.
So with that said, if Chair will take a motion in regards to moving forward or not.
Do we have more time to review? You want the recommendation now?
And just to be clear, we're looking for a recommendation just to start the process, not actually, finalize it. Just if that makes you more comfortable, it's just to start it because we still have to talk to council. And with your recommendation, it just goes up to just give us permission to engage.
Would we be able to get some clarity in October 22nd, where we were on this or where we're at? October, whatever the next budget meeting is, our next budget meeting. Will we have some clarity? Will you be able to provide, this is where we are, this is what we decided, where we're going, or we'd like to finalize it with you guys?
Or would you possibly be pulling the trigger before then?
Yeah, I don't think we'd be pulling the trigger before then. I mean, it's possible. I mean, it takes a good 90 days to get the financing together. So you're talking from today, that's right at the 90-day mark. If there was a need to come back to you all, once we get to the point where we have the documents prepared to say, here's where the savings are, we can do that. What we'd like to try to avoid is, we do all that work and the savings are still where they are today or substantial amounts, and then something change and you say, well, we don't really want to do this. I mean, I don't know why you might do that. I mean, saving $2 million is a lot of money. Like Wendy said, I don't think there's any cons. The only downside is opportunity cost. Mm-hmm. If you wait, rates could go down and you could save more money. Mm-hmm. If that's something that you all want to wait and see, then issuers do make that decision. I can't say that's a bad decision to make. It's just, most local governments, as I said, they set a parameter. If they meet that parameter, it's something they move forward with. It's what Government Finance Officers Association put out different recommendations on when you should move forward with refundings. Some people move forward at like 3% of the refunded par amount. I think it's a little more conservative to say 5%, just because it is an advanced refunding and there's some opportunity cost. But again, we can do whatever you all would like us to do in terms of bringing something back to you at a subsequent meeting. But I think it is important to at least start the documentation as soon as possible, because I think we're all aware of the political situation we're in. Things can change on a moment's notice. We have an election coming up in November of 2020. I think we're pretty safe with rates low through the end of this calendar year. You know, but once you get into the heat of the presidential election next year, I wouldn't even beg to say. If I knew, I tell people I certainly wouldn't be here at city council tonight. I'd probably be on my yacht somewhere if I knew where rates were going to go over the next year. But we can do whatever you all like us to do.
I'd like to make a recommendation that the city go ahead and move forward with the refunding opportunity for the capital improvement revenue bonds.
Recommendation from Jeanette. Do I have a second?
Second.
Second from Orlando. All in favor, say aye.
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 All opposed? Passes 5-0. All right. Wendy, you're up.
Yes, sir. Thank you, Jay.
Thanks.
Thank you, Jay.
We are going to move forward with the third quarter reporting through June 30th, 2019. In front of you, you should have revenue reports, the green bar. We are trying to kind of find the nice sweet spot for you all as to what reports really work for you. Ahead of time, my apologies for any reports arriving a little later than probably you're used to. But we'll get it together, we'll get all your information, make sure you get the packages that you need. So moving forward, we are at third quarter, June 30th. Obviously, the purpose of this presentation, we are presenting April 1st, 2019 through June 30th, 2019. As promised, the information on the reporting was changed to fit the needs that were more relevant, such as comparing fund to fund, revenue outputs, and also net changes within our expenditures. The first slide contains top 10 revenues, and what you used to be accustomed to was seeing maybe the general fund, and then you'd have several lines through different other funds. It was just not apples to apples. So currently what you're seeing here is your ad valorem taxes, which come in at an actual $9.875 million compared to a $10 million budget. It's a 98.2 performance rate, and to give you an idea, as you see the percentages, we currently are at 75% of budget. Therefore, ad valorem taxes are at 98, giving you about a 20% output and performance for that. Sewer service fees are budgeted at $12.1 million, currently at $9.1 million, in actual rev at 75.2 of performance. Moving down, water service fees, 11 million, and actual performance at 8.6, 78% ahead of the 75%. Impact fees are one of the largest top 10 revenues this reporting period, we're happy to see, at 14.8 budgeted with a 14.2 performance, kicking it up to 96.1, being the second to the top in performance this quarter. Infrastructure sales, or your 1% surcharge, is at $4.1 million in budget, $3.0 million in actual, 72.5% in performance. Public service utility taxes, 3.3, 2.1 in actual, 65.7, a 10% slow on that. A lot of it with billing will catch up and have a lag that will come forward. We're always on a lag and trying to minimize that as we print out reportings and take a snapshot of the quarter. County gas taxes, likewise, at $1.3 million, $809,000 in actual revenue at 57.9. Refuge service is at $12.3 million of budget, $9.0 million in actual at 73.4. Stormwater service fees at $1.9 million in actual budget, 1.4, outperforming by 1% above of where we are now. And of course, our OUC interlocal is at 7.4 budget with a 5.2 at a 70% performance in budget for the year. Overall, we're at $78.7 million of actual revenue budgeted with a 63.7 actual rev in, putting us 5% above where we should be now. Any questions?
Is the OUC interlocal also a billing lag?
Yes, ma'am. It's really, the reality of it is more of a, not a billing lag. I would say that the fair statement would be that nobody's going to go out for our money except ourselves. And there's a bunch of receivable out there, and OUC slowly. Last quarter, if you remember, I reported to you a systematic slow. We've updated that status, and we kind of got the same thing. So we're pursuing to get a stronger response to where are we at with our receivables, and let's go get it out there because we have about $2 million out there. But the reality is nobody hustles more than we do. So that's our job now in this fourth quarter that we get into, is trying to collect that and realize that. But that's the honest truth about that. Any other questions? Moving forward, major fund revenues. This is also a change to what you're usually accustomed to. We compared all major fund revenues, your general funds, water funds, all your enterprise funds, and gave you performance of that comparative to, again, the 75%. Initially, I'll give you some update. If you see the general fund right now at $46.9 million and actual is at 29.8, you would feel concerned at 63.6 in revenue. However, that 46 million contains $9 million of fund balance forward, which really, if you reduce the 46 million by $9 million, we're at $37 million in budget. Actual is 29, which puts us really at 74%. That's a percent behind what revenue should be. So that's a very good outcome versus 63%. On the bottom, note that the budget does include 13.5 in prior year fund balance. 9 million I've already called on the general fund. Water fund is at 14 million. 13 million in performance is exceeding at 93.5. Sewer funds 14.4 and in budget 12.4 in actual 86.1. Sanitation fund is at 12.9. Actual is at 9.1, 70.5. St. Cloud Interlocal, here comes our laggers at 7.5 and 5.2 with 70.4 in actual performance. And the building fund is exceeding at 2.9 with an actual of 2.3, putting us at 78.4 for the current period. And finalizing there, stormwater fund at 2.5 with a 1.5 actual output with 61.4. Totals that I had for you, just for you to have solidified the 13 million, that 9 million in general fund. We have obviously budgeted that, but have not used any of it. The rest of it, we've used 12% of prior year fund balance out of that 13 million, which is significantly nothing from compared to what we budgeted. So they are performing well, all our enterprise funds as well as our general fund. Questions? Right. Next slide. Major fund expenditures, same thing. We're comparative to all our funds. 46.9, if you remember, we still have that budgeted number, and we came in at an actual, including encumbrances, of 27.4. 58.4 is the percent of budget. However, I want to note that definitely that 9 million in contingency budget skews the percentage. We never want to be at 58.4. You should actually question me on that, because we never want to be at 75% budget and 58% expenditures. Would probably mean somebody's holding bills, and we're not at that point. Just that 9 million really skewed the budget, just so you know that, and kind of give you the even playing field there. Water fund is at 14. Actual is 12.7, 91.1. We're a little high. Sewer fund, 14.4, 9.4 in actual, 65.6, 10% behind. Sanitation fund, 12.9, 10.5 in actual, 81.4. And funny enough, the OUC interlocal come in at 7.5, budgeted at 5.6 in actual expenditures and encumbrance at a steady 75.8. Building fund is at 2.9 in budget, $1.3 million, 46.2. And stormwater fund at 2.5 with $1.8 million in actual, steady at 73.2. So we're definitely at level. A lot of the cost, some of the cost is actual market cost, as well as some of the services are increasing in price. But nothing completely out of the norm that we haven't been familiar by this time in Q3. Questions?
Why is the building fund only at 46.2 compared to the budget?
Well, some of the things that we have found is that getting that precise snapshot, when we take the snapshot of the budget and prepare these reports, certain things have not been booked in, is the reality. How to capture that, I think, has always been the question of this committee. And so I'm trying to devise what is right, because I don't want to put something in place that adds another level of, this is actual and encumbrances to give you an unencumbered amount as well. I do a check and balance when running these numbers, but we are trying to get a closer picture when we run reports. It's just really difficult, just because traditionally in a private sector company, we would be accruing monthly, right? All her payables and receivables, and have a good picture to say, hey, we got 40,000 out there. Unfortunately, in governmental accounting, we do it annually. So I'm going to try to give you a projection is my idea how to resolve that, of possible accruals through the year that should equate to the trend of the annualized accruals for you to get a better picture. Okay? So that's the only reason, is that lag and snapshot. Anything else? These are just the major funds. It's surplus and deficits, in going over some of the lags in billing, as well as some of the lags when we run these reports. We have $29.9 million in revenue for the general fund at 27.4 with actual encumbrances, including actual encumbrances. It is a surplus of 2.425. This is definitely tracking in the same way. We looked at the general fund and we're averaging about $3 million in surplus. We're projecting $6 million for the rest of the fiscal year. It's a good turn. We want to be cautious about that as well. As we continue to monitor this, we don't want to be so high and away from budget, because that means we're budgeting too far away and to have too much of a cushion. 25% is nice. Anything above that, we're just not, fine-tuning our budgets. Water fund is at 13 with a 2.7. We have a 334K surplus. Sewer fund, 12.4, 9.4 in actual, 2.9 in surplus. There's our trustee sanitation fund coming in at 19.1, 10.5. We've got a lot of costs that have come in a little bit higher with market, meters coming in, revenue not streamlining at the same time, 1.4, which will balance out when the lag in billing, catches up at the end of the year. And the interlocal at $5.2 million, 5.6 in actual, 410K deficit. Building fund, 2.3, 1.3 in actual, 964K in surplus. And the stormwater, 1.5 in rev, 1.8 in actual, and 298K in deficit. Any questions about any deficits or surpluses? Slide.
I know the sanitation fund, we've always had a problem, and there's supposed to be some studies done. Is that going to be in the budget presentation coming up?
We just finished the solid waste study, and we sent the company back to do some additional adjustments that the council directed. I think that those rate changes will take effect after the budget's passed next year. But I can tell you this, the study was done in 2017 numbers, and our 2018 numbers look a lot better as far as the sanitation fund. But there's been some adjustments, such as the council would like us to charge a higher gate rate for Kissimmee and Osceola County for the transfer station. There's some other strategies we're going to put in place.
Okay,
But it's completed. We're just doing the refining of it right now.
great.
Your next slide is the general fund departmental expenditures. Starting it off as a city council with a budget of $7.5 million, which includes $7.1 million in contingency. Throwing off that percent of budget a little bit off, actuals are $267K, making a 3.5%. However, of course, that's skewed with that $7 million in contingency and budget. The city manager and community relations department is budgeted at $720 with a performance of $417K in expenditures, steadying at 58, just about 60%. City clerk is at $431 budgeted, and actuals reporting in at $339K, putting it about 3% above. Legal services, $403K in budget, $323K in actuals at an 80.2% performance. Human resources, $746.8K, coming in actuals at $539, staying very steady at 72.3. Finance with a $1.2 million budget, $844.7K, reporting in at 68.9. Information technology, my apologies, I skipped procurement for you, $665,000 in budget, $464 currently in actual at 69.8. Information technology at $1.7 million, reporting in at 1.1, 62.2. Planning and zoning is 1.189. Again, I'm skipping lines. $1.5 million and reporting it at 1.06 million with a 68.6. Building maintenance at $1.1 million. Actual is 786. There is 66% performance. Police at $15.1 million, coming in at 10.8. It was a beautiful thing to see this hit 71.6% performance. Fire, 8.7, with an actual of 5.9 at 68.5%. Public Works at 1.8 million with 1.2 million in actual results with 67.9%. Parks and Rec coming in at $4.5 million and actual at $3 million, 67% performance. And capital outlay at $325K with 77K actuals with a 23% 0.7 performance. Overall, we're looking at a 58.4 performance in the general fund and expenditures. Again, kind of reminding you at 75%. We're watching that too. We're 10% behind in expenditures, making sure everything gets billed accordingly, but we are in tune with the budget and should be very, very close. Again, you know, our performance this month was a $3 million profit line, give or take, with some, prepaids and inventories that may be reduced in later. But overall, 58.4, I think we're on track correctly for Q3. Any questions on the departmental expenditures?
No.
No, sir? That was really the review. Obviously, the changes were to report the fund at a much bigger picture so that, you know, you could see the departmental performance. We feel that we're in tune, like I said, at this time, and don't have any other comments. I do just have final for Q3 some fine tuning that we'll do, like it's been noted already, about the lag in billing and the snapshot in reporting. Other than that, I thank you very much for the time. Any questions, concerns, comments?
Nope, looks good.
All right.
I believe Donna's ready to rock and roll. She's got her books and stuff in her hand, ready to
Yes, she
step on
does.
up. Your mic on, or you can barely be heard? I see it red. Maybe put it closer to you,
Any better?
a little bit.
All right, just quickly go over the investment performance for you. For the quarter, we had a very good quarter. We had 3.2% annualized earnings. Those are made up of 1.3% of interest income or cash flow, and then almost 1.9% of unrealized gains. And those are the components that roll up into the 3.2% for the quarter. The actual cash flow, or the actual total return was $822,000. Of that, cash flow of $340,000, and unrealized gain in adjustment in value of $481,000. For the year to date, the total return was 2.6%, 2.76 to be exact. We had total return of $2.7 million. Of that, again, cash flow around the same, 1.3%. Actual cash flow of $1.3 million, and unrealized adjustment of $1.4 million, which is approximately 1.4% of the portfolio. As Jay alluded to, the market has priced in rate cuts for later on in 2019. So rates have gone down, and as a result, the bonds that we have in the portfolio with higher rates than the current market rates are more valuable because of that inverse relationship between rates and prices. So because of that, the portfolio had realized those gains. little bit farther down, you can see the components of the portfolio, which show a diversified portfolio. You can see that we are slightly overweighted in treasuries, and that's because we weren't receiving any compensation for buying the lesser credit investment of the agencies. And we have, again, due to the pullback in rates, we have made an effort to extend the duration of the portfolio and lock in some of those higher rates. That's our current strategy. And with that, I'll be happy to answer any questions you might have.
Nice. Like that. Got right to it. Looking good.
Short and sweet. I'm standing between you and dinner or snacks.
You did good. It's always nice to hear us doing well. So, thank you very much. Any questions of Donna?
No questions.
All right,
All
thank
right.
you.
Thank you, Donna.
You're welcome.
All right. Our future meeting, our next meeting will be held October 22nd. That'll be our fourth quarter meeting. Any comments or anything from the board at all?
So at that meeting, we'll discuss the first presentation.
I would hope we'd get some update on where we are with Jay's. Can we make a log of that, make sure that when our meeting does come, we can go, oh, this is what we talked about? Hopefully, we'll see that in our minutes as well, so.
One question I had on that is, maybe it can be brought up in October, are there any other options we've explored to help deal with this coming to term in September of 2020? Is there, I mean, saving $2 million is great, but is there anything else that we could save more on? I mean, I'm not as familiar with that field, but has it been researched or?
Well, when we spoke to Jay and he gave us the presentation, my understanding and what I saw just from regular market analysis, just looking around the standard, likewise, I'm the same with you, that it's not something that I will deem to be an expert on. I can understand the concept. So if that's one of the concerns that you'd like more information about to get a solid answer, I'll put it down to update you with that. And I don't think I have to, maybe wait to give you that information just to let you know, hey, there's possible options. At that point, he had kind of done the research for us to say this is the best that's out there for this current situation. But again,
But is he representing the company he works for, or is he a consultant?
Well, he's with his company as well, so I can definitely, like I said, look into any other options and then get with our debt accountant and see what her thoughts are with, they've worked so long together as well that we have some, confidence in them. But if you'd like that to kind of appease any other options, we can definitely do that. That's not a problem. And we can do that way before October, before, like I said, we jump into anything, because I don't know, like I said, other than speaking with Jay, that was what was the right thing to do. But from his perspective, we can definitely look at something else if you'd like that. Are there any other concerns you want me to note to research for you other than that?
No, just curious if we explored the other options, You said you came from corporate finance, which is my background, and
Okay.
this dollar, we'd explore at least 10 different companies, and
That's not a problem. I'll note that out, so it shows on the minutes, and we'll give you some update on that.
Mr. Chairman, also on page 173 of your budget book, it shows a schedule of outstanding debt. It also shows some of the debt that'll be sunsetted over the next 3 years also, just for ratification. 173. So Member Brown, just to clarify, you see that debt there, there could be some other opportunities for some refinance of bonds and other opportunities that we'll definitely research.
You don't have to make that print bigger next time. My glasses are barely helping.
Or you get thicker glasses.
Everything else is good. That's tinier on me.
No.
Yeah, 5 pages.
Any other questions on the debt that you've seen, or any questions? Back to Bill.
I'd be
I do have a-
curious.
Oh,
Go ahead.
you go ahead.
No, you go ahead.
I've talked too much.
I'll let you be the bad guy.
Okay. Thinking it come from corporate finance.
Yeah.
Do you look at your debt to equity ratio? If so, do you have any worries with that ratio as we're looking at this page here?
Well, the debt ratio, no, I don't have any concerns at this time. We've actually reduced debt this year. It is one of the markers that we were going to go over in budget, so I don't at this moment. You know, or I could say I wanted to add, I had some change recommendations that I was going to present to you all once we get to the budget portion of things we would add to give you those ratios up front so you can see them live as well. And you can make your own determination as well with what we think. But like I said, through the budget, we were going to discuss that as well as the performance of debt. And currently, right now, we've reduced it. So we're happy with it at this point. And I just got about maybe 2 weeks ago, the alignment of debt and how it, you know, should be according to policy or not, and we're, you know, in tune with it, you know what I mean? So at this point, I feel comfortable, but however, we can add that robust reporting to see those numbers live, so you can just see them off the cuff and see if you agree or disagree with that.
And my question was going to be similar as to, you know, what is the city's goal when it comes to paying off debt? And you had mentioned that there's certain things that are written that you guys, what are those numbers? What is that goal?
So that is one of the biggest recommendations we have, or I have, as, you know, now putting a little wind under the wings here. And it's really just quantifying these words that keep coming up, such as growth, debt, the ratios, the performance of AP to AR, and what we're looking at, because a little bit of the understanding, and you all may know this better than I do, but in governmental accounting, we have such a long time, and when these adjustments happen to realize everything. And so kind of getting a soft close, if you call that, is something I have in the works to do, to report a little bit better snapshot of things. And I need those numbers as well to know, are we at a 52% ratio between AP and AR? So, you know, are we having more bills than we do money in? Because everything has a trickle effects, and that's definitely a recommendation that you'll see in the budget workshop, which is to know these numbers in order. I can't tell you right now, are we covering cost? And that's a goal that we have, you know, in conjunction with the city manager's vision of unbalancing the budget as well, you know. So you're correctly right that there should be some numbers that you can say, so you can determine and say, well, you know, Wendy, I'm going to call on you for that number and be like, it's not. So that was kind of the introduction with this presentation, where before you didn't have comparative to know, hey, the budget's at 75% and you're at 50, why? So as we continue to kind of give you that fine tuning of what you're looking for, because what you may look for is not something that resonates with you. So kind of finding and making everybody happy, which we won't, but I think we can get really darn close, and finding, streamlining that is one of the goals of this budget period, so.
Any other questions? All right, thank you for that. Meeting will be adjourned. We will reconvene for our work session at 10 after 7.